Hello everyone. In today's video, I'm going to cover TD Bank, one of the fastest top 5 growing banks in all of Canada. Now, this bank is a premium bank, but it's no longer trading at premium prices right now. So I'm going to cover its latest Q3 earnings because that's going to give us insight on whether this is still an opportunity right now and what does it mean for its dividends. Also, I want to cover the risks before I talk about the rewards and what I'm planning to do with my TD Bank stocks right now. So, if you are an income investor or you're looking to purchase more positions in TD Bank, then you got to be watching this video today. Hey everyone, if you want me to make more of these videos for you, please smash that like button so that you let me know to make more of these videos for you. And please, if you're watching this video and haven't subscribed to my channel, please hit the subscribe button, the bell notification button, so you get the latest, greatest videos on investing, like real estate, stocks, coming to you every single week. So let's get back with the video. TD Bank has been one of the best performing banks in all of Canada for the past 5 years. It's also been paying its dividends for so long, like more than 100 years. That's why it's a dividend aristocrat. It's also been around for 150 years. So let's just say that this stock is like a super safe type of style stock. But because of the situation we're facing right now, is this the case? So let's hit its latest Q3 earnings and check out what its latest revenue is looking like, its latest earnings, and whether is this dividend safe right now. Now, TD Bank is one of the top 6 banks in terms of assets and market cap in all of North America, which is pretty cool because I didn't even know that. It's also got 3 major revenue arms, being the Canadian retail arm, the US retail arm, and the wholesale banking arm. As you can see, the Canadian retail takes up 55% of its earnings growth. And then the US retail takes up 31%, and then the smallest one is wholesale banking. And what's interesting is that it even shows that TD Ameritrade, which is its discount brokerage, is about 9%. And this is really, really interesting because it took up 42% ownership by acquiring TD Ameritrade not that long ago. Now, in its Q3 2020 financial highlights, what was really, really interesting to me was that it had record-breaking revenue in all of history, given its crazy, unusual circumstances this year. Another interesting thing was its Canadian retail and its US retail, which is the majority of its earnings, was actually down compared to last year. Now, the only area that it did grow was wholesale banking. And within wholesale banking, it was narrowed down to really the TD Ameritrade sector, which is its discount brokerage. It says that it's received more and more revenue, a big increase from last year because of all the trading fees, which is probably why it's contributing to the crazy volatile stock market that we're facing right now. Anyway, TD Bank was able to take up on that opportunity and raise its revenue. Now, one of the key takeaways I got from its Q3 earnings was that it made a lot of sense. Of course, it's making bigger and bigger allowances for credit losses in the US and in Canada. But out of all the credit losses, I was more interested in the types of loans that TD Bank was making in some particularly risky sectors. So you can see that in the entire circle of loans that it's been making, the majority of it has been 46.9% in HELOCs and residential mortgages. And then only a small percentage of all the loans is actually allocated to commercial real estate, the oil and gas industry, the retail sector, and transportation, being airlines, which is only about 7.4% of all the loans that they've been making. And only less than 1% is in the oil and gas sector, which I would say obviously has not been performing super well this year. And the other part of it is less than 1% in the automotive commercial area, being airlines. So that's really, really positive. It's positive because then in terms of potential loan losses, that it's actually not making up a big proportion of its entire portfolio of loans. Another key takeaway I got from its Q3 earnings is that TD Bank, of course, has been naturally making more and more provisions for losses for this year quarter after quarter in the Canadian market and in the US retail market. But what I'm more interested in, and I'm sure what you guys are more interested in, is what type of loans are they giving out? And out of that percentage, what are they likely facing in terms of losses? So, because obviously that would mean what it could do to its revenue and then translate it to its dividend safety, because obviously if it's making a lot of losses because it's making a lot of bad loans, that means it has less revenue, less earnings, and then it could mean, not that great of dividends. Now, what does this mean for its dividend safety? So in terms of the dividend yield right now, it's going to date this video again, is 5.3%, which is pretty high compared to all of history. What I see is that its payout ratio, what they're saying, this target payout ratio is between 40 to 50%, which is really, really good. And that's what they're promising. Right now, its dividend payout ratio is 52%, but what they're targeting in the upcoming years is actually between 40 to 50%, which is a lot more safer. I mean, ideally, it'd be always less than 80%, but given the circumstances we're facing right now, given that the banks do a lot of loans and they're a bit riskier, of course, you want to see the lowest payout ratio because then that means that it can increase its dividends over the upcoming years to investors. As a dividend income investor, I'm looking for predictable revenue growth, predictable earnings growth, and predictable dividend growth because I want to see all three in order for me to have security investing in a dividend stock that's like super boring, not volatile, and pays out steady returns. And it potentially could give us a bit of a prediction of what it can do in the upcoming years. So you can see that its revenue growth has been growing steadily in the past 10 years. Its earnings has been steadily growing in the past 10 years. And its dividend has been growing exceptional in the past 10 years, averaging 11% in annualized growth since 1995, which is like, wow. Now, in terms of its financial health, I found it exceptional. Like in terms of assets, it has $1.1 trillion and debt is only $359 billion, which is like kind of chump change against $1.1 trillion. But let's look at its cash, and holy smokes, its cash is actually at $542 billion. So basically, it could pay out its debt lickety split if it really, really wanted to. So essentially, TD Bank has an amazing financial balance sheet. Now, before I jump into what I'm going to do with my TD Bank stocks and what do I think about its dividend growth, can it keep up with 11% every single year of annualized growth for its dividends? I want to touch on its risks, which could give you a bit of intel of what I think about the TD Bank stock. The number one risk I see is that we are going to be in low interest rates for a long time, like for a long, long, long time. And this is really how most banks make a ton of money in its revenue is through the spread. So because it's going to be low interest rates for a very long time, I'm suspecting that TD Bank has got to like pivot really quickly and find other ways to make money. But I'm pretty confident that it will because most banks make like millions and millions of dollars every single day because they're going to charge you different fees everywhere. The second risk that I see is that loan defaults. Now, with the different types of government stimulus ending pretty soon, we're probably going to see more and more loan defaults. Now, the good news is that TD Bank only has 7.3% of its loans actually allocated to the more risky sectors, being retail, commercial real estate, the oil, and it's the airline. So, which is good. But again, like I said, it's because the stimulus from the government is ending very soon, we're going to see more and more loan defaults. Now, the third biggest risk I see, and no one's really touched on this for banks, is that like the housing market. Now we can see that 46 or over like a huge in the 40s, the majority of its revenue is from residential mortgages and HELOCs. Now, of course, in some parts of Canada, the housing market is like insane. It's like crazy, crazy, crazy. Even Ottawa, in a very boring city like Ottawa. But how long is this going to last? It's only caused by like low inventory, but we don't know what the future is going to be like in 6 months to a year because the housing market is a lot slower than the stock market in terms of reacting to the economy. Now, given that the federal government stimulus funding is going to probably end very soon in the upcoming months, I think even in for Canada's like end of September, this could mean a slowdown in, people's financial health, meaning that they don't have a lot of money now because the stimulus is ending. So does that mean that we're going to find more and more people not being able to pay or afford their mortgages that they have right now? All I'm trying to get at is the future is uncertain, and considering that the majority of its loans is in residential mortgages, the housing could have an impact in it in the 6 months to 18 months. So I'll just say the future is uncertain when it comes to the housing market. Now, the fourth biggest risk I see is that its majority of its revenue growth was in the retail discount brokerage sector with the TD Ameritrade. Now, how likely is it going to continuously increase its revenue? We've been in a very volatile stock market, so they've been able to profit really well this year, but I have no idea, is this going to continue in the upcoming years, and what does it mean for its long-term revenue and earnings growth? Okay, so what am I going to do with my TD Bank stocks? TD Bank has been around for the last 150 years. It's been paying its dividends on annualized growth rate at 11.1% year after year. And it's got amazing financial balance sheet with amazing asset value. So all to say is that I'm planning to hold for the long term. Now, I'm not expecting to have it double-digit dividend growth over the upcoming year or two because even the CEO said its future is uncertain. But I have no fear in its cutting its dividend. In fact, it increased its dividend like over 6% this year. When you look at it, how it behaved during the financial crisis, it still increased its dividend. So all to say is its dividend is ultimate safe. Now, do I think that it has a lot of upside value in terms of the stock price? I would say not so much over the upcoming year or two. You can see with its PE ratio, it was trading really low in April. Basically, almost every stock had a big drop, so it was trading pretty low. And its PE ratio was trading at its one of its lowest PE ratios for the past 5 years. As you can see with this PE ratio right now, it's a bit rich. Now, when you look at its forward PE ratio, like based on its future revenue and earnings growth uh, targets, then it's trading a bit healthier. So all to say is if you hold it the long term, you'll be fine. But I'm definitely not going to be making more and more positions until its PE ratio actually drops to a little bit lower because I look for undervalued stocks. But as an income investor, its dividend is like super safe. Anyways, I hope you found this video super helpful. If so, give me a thumbs up. And guys, let me know in the comments below. What do you think about TD Bank? Do you like TD Bank more or Royal Bank? Let me know in the comments below because I'm super interested. Personally, I prefer TD Bank. Anyways, I'll see you in the next video.